We're here with Daniel Blum. Daniel is the founder of Evan Capital, a Texas-based RIA, and Glenhaven Capital, a CPO, commodity pool operator. Both companies utilize the same rules-based investment and trading philosophy. So, Dan, really appreciate you joining us.
Thanks for having me.
Absolutely. To jump into it, why don't you tell us a little bit about your background and how'd you get into business?
It's funny, so much of the way that you approach business is shaped by your early experiences. And I happened to, basically hit adulthood when the tech bubble was in full throttle, and was watching, not everybody, but a lot of people around me who really had no clue what they were doing. A bunch of early 20 somethings making money hand over fist on JDS Uniphase and all these high flying stocks. And there was a period of time. I remember a restaurant that we would go to pretty regularly, where one day I noticed that we couldn't get any of the waiters, and it was lunchtime. Turned out all the waiters were in the back in the kitchen, where they had CNBC, on the TV, on multiple TVs. All the waiters were trading these stocks, and a week later, one of the waiters pulled up in a Ferrari, and it was such a ridiculous time. And then to ride that bus down and to see, those same waiters have to sell their Ferraris and go back to actually waiting tables. And then, I, of course, was one of the last to finally buy into, all right, I got to buy into one of these high tech index.
Is this like 99, 2000?
99, yeah. It was late 99, early 2000, really just as I think I may have timed the peak almost to the day or week, where I put a big chunk of my meager savings into the Munder Technology Fund, which then I think plunged 90%.
Oh,
I think it had outpaced the NASDAQ plunge, which was like 82%.
wow.
But it was going through, that first bust, and then the great years from 2002 to 2006 or 7 in the housing market. And I was working in commercial real estate on the finance side, watching, people just mint fortunes for 4 or 5 years. And I was really just kind of providing capital to those people who were minting fortunes. But then to watch a lot of really, high quality businesses in that real estate world get completely wiped out in 2007 and 8, really, it really shaped my way of thinking and my approach to investing. And I watched even, a lot of people who are close to me, won't name names, just absolutely panic at the trough of '08, sell everything that they possibly could. At looking back, were bargain prices, but kind of, really feeling the pain of that period forced me to come up with an approach that I could stick to from an investment standpoint. And it really, led to many books, really starting with kind of the classic, the market wizards. I actually met Ed Sakota, who was he was one of the original market wizards. But spending time with people who had the systematic rules-based approach to investing and trading that really resonated with me, because I knew that I didn't have the instinctive, I was an emotional investor. I needed to have some sort of framework to approach the markets if I wanted to have any success. And from there, ended up starting the CPO, Glenhaven Capital.
Yeah. And so 2000 through 2008, you saw a lot of people make a lot of money. You saw a lot of people lose a lot of money. What were you doing at this time? Were you in the industry?
I was in the commercial real estate industry at that point.
Okay.
I had gone to, after 2000, I actually, commercial real estate was terrible. And that's where I was working up until 2000, 2001. Ended up going back to business school and went to NYU, and happened to time business school great from an education standpoint because we had Oswald the Motorin was one of my professors, unbelievable valuation guru. Uh, we had Nouriel Roubini teaching global macro. He became, well-known Dr. Doom on CNBC, and he was unbelievable in the way he could connect macro events from 1880 in Portugal to what happened in different currency markets across the globe. He just had this amazing ability to walk you through the different steps. So I had this incredible exposure to brilliant minds in trading, investing, finance, but then graduated in 2003, which was a terrible environment to get into trading. And I really wanted to be a trader.
Yeah.
There were no jobs, especially for people who had no background in trading like me, and ended up defaulting back into commercial real estate, which I enjoyed. There are a lot of great people in that industry, but the lack of liquidity, the timeline that these projects took, from conception to actually harvesting your investment, just to me left you so open to luck. I mean, when you have to think on a multi-year time frame, you just have to believe in what you're doing. And I'm not sure. I think I came to the conclusion that I wasn't exactly wired for that world. But it was fun. We financed a lot of great projects over the years, but I knew it wasn't something that I really wanted to do long term. So when it actually started, my mom, we were living in San Diego. My mom was diagnosed with cancer. We knew it was a bad cancer. So I convinced my wife to move back to Houston. And that's a tough move, going from San Diego back to Houston. But she was being treated at MD Anderson. And it gave me some time. I left my job in San Diego. Gave me some time to really reflect on what I wanted to do. And in the meantime, had connected with one of my old bosses who he and I had been trying to develop trading strategies together just on the phone. But now we're both in Houston. He's a fair amount older than I am, a lot more experience as a lawyer. And we basically said, hey, we got to figure out a strategy. We both believed in rules-based investing. And, it was really just to handle our own money when we conceived this. So we started doing a lot of research, met a lot of people, and just luckily met a fellow who happened. He was he was a friend of a law school friend of my now business partner, Jim, and had a long background developing quantitative futures strategies, and was spending several days a month in Houston, but he was working on an assignment for a family office out in California. And he became our coach and quickly showed us how little we knew. And which was frustrating, but at the same time it was refreshing. It was like we're not equipped to do this ourselves. And several months later, we met him at Starbucks, and he said his engagement had ended, and we ended up convincing him. We convinced him that it turned out when he told us who he was working for in Orange County, we knew he was a smart guy. But when he told us he was developing these strategies for Ed Thorpe, who was a legend in the quantitative finance world, we were like, all right, we got to really take this guy seriously, and we may not have another shot at trying to work with him. And we convinced him if we could raise a certain amount of money, can you basically show us your best strategy or whatever you think is the most robust, and we'll raise a fund around it. And personalities really gelled. So we ended up in 2010 launching what was our first long and short trend following futures strategy around a system that Howard had really developed in 2001 with data from 1970 to He developed in 2002, but it was with data up to 2000. So it had a ton of out of sample performance, and it was a very relatively simple strategy, very long term. Um, we launched it. We raised all friends and family money. Most of the investors had no idea what we were doing, and a lot of them are still investors, but and still really don't understand what we do. And that's one of the difficulties of running a strategy like that, because everybody loves
Yeah.
everybody loves the concept of non-correlation, and that's kind of what we pitched. We said, hey, we just went through this horrible period in 2008. Most of our investors had lost a lot of money on paper, and here we have this strategy that really, has the ability to make a lot of money in these crisis periods. And everybody's like, all right, it sounds interesting. We trust you guys. We know you're not going to steal our money first. But we launched the fund and had a good first year, and then went into a difficult 2012.
Yeah.
And 2012 was tough for all most trend followers, but it was.
So
Sorry, go ahead.
what made you guys choose commodities as opposed to stocks?
Yeah, at the time, it was his background. It was much easier to first get the data and back. Well, it really started with the fact that you got exposure to much more diversification through the futures markets. Generally, stocks are highly correlated with each other, and the ability to go long and short with equal ease in the futures markets. Being able to go short basically gives you double the opportunity set in your trading, and being able to trade cotton, gold, crude oil, the German DAX, the JGBs, to have this wide universe of different markets to trade was, it gave us a much broader horizon of opportunities. So that's really what attracted us to the futures. But it was also a function of Howard having much more experience in that space. Knowing how to scrub the back data, to how to back adjust it correctly, which I didn't know how to do when we first sat down. But the opportunity set in the futures market is just much greater, and we still believe it's greater. The liquidity is deeper.
That's really cool. I find it fascinating. Obviously, where you started, you understood yourself as an emotional investor, and you needed a rules-based system, right? And then you went through this process. You got a great coach, got a partner, watched the fund, friends and family money. Difficult time in 2012. How do you have the conversation with investors when times are tough, given how you are? I mean, obviously, you felt the pain. Maybe that was just how you explain it to your investors, their friends and family. That's a little bit easier. But talk to us about how that conversation happens when it is tough, when times are tough. How do you kind of level set expectations with investors? Like, hey, this is normal. This happens. Things happen in cycles. This is how you can explain it to them.
That's a great question. I think it starts with your confidence in what you're doing, which back at the time, our confidence level was, we were relatively new to it. So, you can look at all of the back testing you want and get as comfortable in your mind as you can that you could have sat through X, Y, and Z. But until you live it, it's just a completely different scenario. And back then we were new to the business. So, we could sit there and confidently tell our investors that we're sticking with it. We believe in it. We've looked at all the back data. But I think at the time they could see in our eyes that, hey, these guys are relatively new to it. And most of our investors stuck with us. But this kind of leads to the next part of the story, which is the most difficult part of running a rules-based strategy from a manager's standpoint is actually sticking to it. And we lived through, and I was the guilty party in this because I was the young guy in the team, and I thought I was smart. And 2012 hits. We're running this really long-term system, doesn't make many trades. You're in positions for months. I start looking at things that we could be doing differently that could be really impacting performance, and found that taking short positions really hurt. And then also that we were getting into these trends very late, or signaling, seemed like we were getting in late, and that we had all this open equity risk in our positions. So I presented my research, when we were in the absolute, low point of a drawdown, showing my partners that we really should be, we should make some dramatic changes to our program. And we basically ended up committing kind of the cardinal sin in systematic investing, and we made a change to a dramatic change to our strategy at the low point, and hugely exacerbated the drawdown. It's times like those where you realize how hard it is to stick with these programs until you absolutely get punched in the gut by not sticking to it. So we learned this, just incredibly painful lesson. And we were, at the time, we were running a much more volatile version of the first fund that we launched. So we hit it, we're running a 40% volatility program, which we still run. And it just hugely exacerbated the drawdown that we went into. But it was an incredibly valuable lesson we learned early on, that first you stick to your rules always. And if you're going to make tweaks, which we don't do, you do it at highs. You do it when things are good. If you really believe that the change you're making makes sense, then you might as well wait until you're at a new high and say, all right, now I'm going to make this tweak. Not doing it from an emotional standpoint. You're doing it because you really believe that this is going to enhance risk-adjusted returns. So I think looking back, you realize what you think is going to be easy because you've got these rules, you've got a great program. I had it, and it was a great program. Most people can't stick to rules, and that's.
So you broke your rules. You had a significant drawdown. What happens after that? What you guys do after that? You kind of reset. You go back to what you were doing prior to that.
Yeah, after several years, we did essentially go back to kind of a blend of what we switched to, and then what we started with. So multiple time frames. We went back to taking short positions, and that was really. And we stepped back into that. So we didn't make any dramatic shifts. We were like, all right, we're just going to step in over a period of a year. And that was early 2016 that we finally basically cemented the trading program that we still run. And for most of our investors have stuck with us, and our track record's completely bloodied by that period. And I think most fund managers would have absolutely shut down the fund, restarted a track record, and we didn't, because all of our investors were people we cared about, and it just didn't make sense to do it for that optic reason. But we'll live with it forever as long as we can continue trading. That's everybody who sees our track record is going to see the huge mistakes we made, but it shapes you, and it helps with our Evan Capital, which actually Howard. That's an RIA business that we run that we started in 2016. But actually, it had Howard who developed the trading strategies at Glenhaven. I asked him, since we were running a very volatile hedge fund CPO, I needed some vehicle for money that I might have to want to tap into when we're in a big drawdown in our fund, and said, hey, can you help me develop rules? I want it to be low volatility, long only ETFs with no need for futures.
Yep.
Really just, I want to make sure that I don't lose a lot of money in that strategy. And that's where we developed what we trade for clients with Evan Capital. And the idea is that you get these really big diverse ETFs and allocate a meaningful chunk of the portfolio to these different ETFs.
Yeah.
And then overlay a trend following system, very long term, that has the ability to take any one of those buckets to cash. Because I knew I wanted to have some rule that would be kind of my blowout preventer that would tell me, hey, it's time to actually move to the sidelines, but then force me back in when the rebound happened. Because I saw so many people, including myself, in the aftermath of 2008, 2009, you never know when, if you pulled out, getting back in is impossible.
Yeah.
I mean,
it's tough.
Yeah.
Everybody's getting wrecked. Yeah.
Especially, and then you look back and you're like, all right, the S&P, I don't know if it was it reclaimed its high by 2012 or 2013. Now you're up 100% from the low. You're not going to feel much more comfortable. And then today, you look back, you're up 800% or 900%.
Yeah.
It's so difficult.
Yeah. So you created that M Capital RIA. You created that in 2017-ish.
That was 2015 that we started the company, and really 2016 we started started bringing in outside investors. I say we. It was me. It was just me. In 2015, I brought in a partner in 2017 to help grow it. Mike Mann. He's the idea was, when I started Evan Capital, I just thought that it was a product that a lot of people could benefit from, especially people who don't have people in the neighborhood that don't have a background in investing, but either get taken advantage of or just really, they are taking on a lot more risks than they think they're taking. This was a way for them to get broad exposure and have some risk management, because I think it's important. But
actually, kind of like tee up here. So for those listening, Glenhaven Capital is a CPO. Evan Capital is the RIA, so the Registered Investment Advisor. So what was the premise with Evan Capital?
It was really to apply the same principles that we use at Glenhaven. This belief in trend following, where you let your winning positions run and you cut your losers short, and that you're always taking positions in the direction of long-term price movement. That price is all that matters. We're not doing any fundamental analysis. We're just hopping on the train when the train starts moving. And with Evan Capital, it's only in the up direction that we jump on the train. Doesn't mean that it goes up once we're in.
Yeah.
But once we're in, generally, you're in positions for months and years. But if we get into a position and it goes against us, you're cutting those losers short, which goes against pretty much everything that I think we're wired to do as investors. And it's tough to do even with ETFs when you're really looking at these long-term signals, because deep down when it tells you, all right, it's time to exit the S&P, that it's just going to bounce. Then I mean, you're just going to see the mother of all bounces. And there's a big part of you that says, I can't, let me just wait a week. Or let me wait a day.
Right.
And I think unless you've gone through the pain that we've gone through, that I've gone through, you're always going to be tempted. And as soon as you wait a day, wait a week, and then it keeps going down, then the emotional pain is so much greater when you ignore your role and it goes against you versus when you just accept and take your role and it goes against you. So there's that comfort.
Sure. Yeah. I mean, I'm curious, from obviously the two different products, going into it a second time, knowing what you dealt with and experienced in the past, how was the conversation with the investors for Evan Capital? And the day in the world where everybody has a complex strategy, simple is important. Right? How you explain that, and then how you raise capital. Did you raise capital from friends and family on the second program, or was
we did? Okay. We did, and that grew much more quickly beyond the friends and family, because it's much simpler when it's in your Fidelity account. In this case, it's in your Fidelity account. These are assets that you can see every day. There's hardly any trading. It was much easier for people to understand what they're in.
Right.
When you're talking about a futures fund where you got monthly liquidity, but it's long, it's short. It feels, I think for most people, it feels much more black boxy, and it is more complicated. But with the Evan Capital strategy, that's ETF based, it's simpler, it's much lower volatility. It's just there have been a whole lot less conversations with investors about that, because they really, and low volatility is such a beautiful thing from a manager's standpoint. And that's another point that we talk to investors a lot about volatility, because there's this idea that which makes all the sense in the world, that I want my overall portfolio to be low volatility because I won't panic, I won't make bad decisions, I'm going to stick to my plan. Makes all the sense in the world, but that translation then, when it goes a layer deeper into the portfolio, it gets quickly lost in my mind, and it's just my opinion. But people generally try to apply that same principle to the underlying investments in their portfolio and say, I only want to invest in a fund, if it's a hedge fund or whatever vehicle, I only want to invest in low volatility vehicles. Well, that may not, to me, that the math doesn't always make sense, and sometimes makes the opposite of sense, because if you're looking to invest in a strategy that is not correlated to the rest of your portfolio and really isn't core to your portfolio, the math actually works better to go for the most volatility that you can find and allocate less money to it, because mentally you're pulling less away from what you believe in and is kind of your core portfolio. But if you can allocate less money, and you can only really do it in the futures space, so it's
leverage,
the leverage that's available, and it's essentially free leverage. You're basically leveraging your position at the risk-free rate. The math says that you should go for the most volatility you can. Obviously, you don't want to invest in strategies that are likely to just blow up because they're too over leveraged, but allocate less money to a higher leverage version of that diversifier. Cliff Asness wrote a great paper about it recently. I think it was called In Defense or In Praise of High Volatility Investing. And he makes the great point. He's like, the math makes sense, but nobody can do it. And that's what, we struggle with, because we run this fund that's runs intentionally at such a high level of volatility because it was initially really just for my money and my partner's money, because we saw all the cash that we were just sitting on for investors and they were paying fees on. But the reality is that most people, stomaching double-digit ups and downs every month, even if it's on a line item, is just so difficult. Low volatility, just low drama, less conversations with investors. People don't think about you, which is what you want as a manager.
Yeah.
You don't want people focusing on you.
Sure. What type of investors do you work with at Evan Capital on the RIA side?
It's a mix of, we have investors that are retirees. We have trade investors that are energy traders, doctors. We work with several clinics where we, just handle their retirement accounts. So we work with a variety of clients, and there's really there's no minimum. So, we're not, in my mind, this was a way to offer hedge fund like product to mainstream investors, where they would get real exposure to different asset classes. Hedge fund's kind of a bad word now. So that's not the word that I want to get out, but it's that concept that you can get access to a dynamic risk management approach without paying a lot of money, and you don't have to be a gazillionaire.
Right.
And they just recently raised the minimums for QEPs. So now to be in in most commodity pools, you have to have $4 million of investable assets, and it limits the world of potential clients.
Right. What do you, I'm curious, current state today, in 2025, where do you see challenges in the current environment relative to the two different strategies, one on the commodity side, obviously on the Evan Capital side?
I think the biggest issue for everybody is just, diversification doesn't matter anymore. It's like nobody cares. Or the belief is that I'm getting diversification by going to leveraged equity, going into private assets, or leveraged credit and private credit, that we've just had this incredible tailwind in so many other assets that have high correlation to the S&P 500, but it's done so well, and every dip's been bought. It's just gone on for so long, and products that offer diversification just don't. They're just not sexy, and what's awful is you look back at 2008 and trend following CTAs had a banner period and raised a ton of money. A lot of funds just raised billions of capital, and then kind of went sideways and flat to down for 10 years. And so it colors your perception as an investor. You're like, well, my odds of having exposure to something like that could do well, and in an 2008 scenario, pretty low. And for now 15 years, every time there's been a dip, it's just everything's rallied back.
Are investors complacent, in your opinion?
I definitely, yeah. And I think it's so funny when you talk to. I remember conversations in the trough of 2008, 2009 with people who were really smart, who said, if this thing ever gets back to even, I'm out. And now those same people, now that their portfolios tripled, quadrupled, like they're like, man, if there's a dip, I'm just adding. It's and now you see all the taglines that it's time in the market, it's not timing the market, things that are fundamentally kind of sound advice, but that are just so easy to say when the market's gone up. You're looking back, at a pretty straight line to where you're standing. Yeah, staying in the market for the long haul looks great. It didn't look great at the trough in 09, but everything's easy now. So it's there's a complacency out there.
I mean, on that note, CTH space has been tough. Commodities have consolidated for the last, I don't know, 10, 15 years. But it started to change. Gold is a great example. Like gold has really broken out over the last year. Like what are your thoughts on commodities?
Well, it's just funny. Gold, we joke about gold because it gets very little love. Like you see very little press about it. It's had an incredible run. I don't have any prediction because
not so much gold, just like commodities as a whole. Like I obviously specify gold, but there's oil, there's ag, whatever else you guys are looking at.
I think it'll be interesting to see, if we can get some sustained breakouts in any of. I mean, gold's definitely had a nice breakout. Silver, it's been pretty range bound. A lot of the other metals have really just been in this terrible range for so long. The grains have been in this long downtrend, maybe starting to see some life to the upside. But and then crude oil and all the energies, there's just, you've just had this sideways chop for so long now. We've just been waiting for some break. It'd be nice to see something go cocoa or coffee on us. But, that's another amazing, cocoa is, a lot of people talk about, cocoa is kind of like our Bitcoin, but, or
it has been.
It's just like, but if you looked at cocoa, and there have been some great posts about it recently. If you look at cocoa up until like 2 years ago, it was like the worst market for any trend follower. It just chopped in a range. It's terrible. Anytime we'd get a signal in cocoa, you knew it was going to be a loser, either long or short. And then, so I think a lot of trend followers, not a lot, but I'm sure if you were looking at your portfolio and said, hey, I want to cull some markets, cocoa would have been the first one to raise its hand and say, there's just no reason to trade this thing. And then it went on a tear that, we look at risk multiples of trades in our fund. The risk multiple of a good, typical good trade, maybe it goes up 3 to 5x your risk. Cocoa and London cocoa were up like 100 plus times, what a typical, saying my estimate of what a typical trend follower would put on their risk per trade. I mean, for something to go up that multiple of the range of his trade is just, it's unheard of. And coffee has had incredible run too, but it's, I mean, we'd love to see that, that 2000 to 2009 period repeat where, anything you traded was great. Because then we had a 10-year period where the S&P 500 was pretty much it. And NASDAQ were the good trends. Now we're seeing the European markets finally. I mean, I think the Euro Stoxx 50 just broke its, just recently eclipsed its high from 2000. It's just insane when you look back at some of these markets and realize how long you can go in a tough period because we're so spoiled in the U.S. by what we've experienced.
Yeah, absolutely. You ever look at, obviously you came from the real estate space. You ever look at the real estate side of things and kind of just ponder what happens?
Yeah. I mean, I missed like some of the, one of the greatest, I got into trend following, literally at the worst possible time and got out of real estate at the worst possible time because then real estate went on this incredible tear. Interest rates went to the floor. You just had this incredible tailwind. It's easy to always believe that tailwind and it's usually interest rates,
Mm-hmm.
or, that you're a genius because you had that, you had that tailwind. But yeah, I think you gotta become comfortable in the fact that you can't time these things.
Right.
I think that's why there's always a reason to have exposure to different either asset classes, different trading styles. There are just so many different ways to diversify, but also so many ways to think you're diversified,
Yeah.
but you're really making the same trade. And that's where, like, that 2009 to 2020, 2022 period, a lot of there was just a tailwind lifting so many asset classes that you could look back and say, I was diversified having real estate exposure. Well, yeah, you were riding interest rates to some degree, and you're riding interest rates and collapsing volatility, and it's an incredible trade. Who knows when any of those trades end, and
Right.
but real estate's an interesting space.
Yeah.
It's still fascinating. It's great to see how it's expanded from when I got into it. It was very much an institutional world.
Mhm.
Then the REITs took off and it became more democratized. And now you've got all these crowd-funded projects, and anybody can invest in really risky. I mean, you can access anything you want. Whether or not you really should is the question you should be asking yourself. But
Right.
it's people love real estate, and I get it. I mean, you got a hard asset. There's always going to be comfort in owning a hard asset, but there's always, you always got to back up and say, well, yeah, I own that office building or that strip center, but I've also got 90% debt on it. Yeah, dude.
Yeah.
No, I don't really own it.
Hey, things go sideways real fast.
Yeah. Leverage in real estate.
Yeah.
That's
interesting. Yeah. I think to your point earlier, because diversification, like just being in the game, in the market, right? It's important. It's
big time.
crucial. Yeah.
Big time.
And whatever you're doing.
We believe in diversification, and we believe in rules, and try to keep it simple, and try to not get in our own way. I think that's just the toughest.
Yeah. Well, one question for you, just as you talked about, you got a partner, you got a coach. How obviously you've learned a lot over time. How are the conversations back and forth? When you guys looking to make a decision, maybe you have a different decision or your partner does. How do you guys kind of go back and forth?
So, I mean, I'm still the emotional one in the group.
Okay.
And, I'm fortunate to have a partner, at least on the hedge fund side at Glenhaven. My partner, Jim, who is a lawyer, he's very disciplined. He is, hey, we stick to the book. We stick to the script, stick to the rules. Anytime I bring up ideas, he's like, we've got to spend years testing this before we would ever implement. And so we all, he definitely checks me. But that's because on that fund, it's so volatile that you're always, it just makes it so much easier to be when you're in a big drawdown, it's much easier to get into that emotional state.
Yeah.
With our business on the ETF side, there's very little emotion. It's such a different ride from an investor and manager standpoint that you never feel that pain in your gut that, oh my God, I mean, this is, which is, that it makes it much easier to stay out of your own way in that space. But generally, I know when I get that pain in my gut on the fund side, that's usually close to the bottom. The time that investors and should be adding money, but it never happened. I mean, we ran a managed account for years for a very sophisticated European platform where they had spent decades investing with CTAs, and they actually had the fortitude to say, now's the time to, they had their volatility bands around each manager's equity curve, and they actually had the fortitude to say, now, you're in a 30% drawdown. It's time to add. And they would take money off when you're hitting new highs. So we knew that they had that sophistication, and because they'd been in it for so long. But the majority of our investors they're not steeped in the space. And it takes a certain type to, and I've seen it long enough that I'm willing to step up and come in at, in big drawdowns or pull money off, in big run-ups. But you're either steeped in it or I do believe that you should always have, you should always be rebalancing. I mean, if it's, when we do that within our Evan Capital strategy, but then also as an investor looking at your overall portfolio, I think if you've got these little pieces that are diversifiers, especially if they have the ability to go up, big or go down big, the more the volatility is amplified, the more important it is to rebalance at least, periodically, keep everything in line. Nothing brilliant to that, but it's hard. It's easier said than done.
Yeah. Right.
Always is.
But
Dan, what advice would you give to somebody that's looking to launch their own fund?
Looking back, I think the key is to work for somebody else who's already running a fund, and just to see the difficulties that go into it, all the different balls that you have to juggle, because I think a lot of times it sounds easy, it sounds sexy, and until you've seen the pain that other people, your boss, your superiors go through, it's just it can save you a lot of time and a lot of heartache, coming from, working underneath somebody who's already running a fund with outside investor capital. I just think that if you can find a job like that, and I know they're hard to find, that's probably the way to start.
It's a great point.
Yeah.
You could go there, you could learn from them, and then, hey, you got this idea for a fund, you could bring it to the table and have a stake in it. Yeah.
I would absolutely recommend that than taking the path that we took, looking back, learning lessons the hard way. And, I think I had brown hair back then. It was just like, it was just a totally different mentality. Like you get beaten up. But if you can compress that learning period and the pain into a shorter period of time, I think you might as well do that.
Right.
Yeah.
Makes sense. Very
cool. Any final thoughts? We start to wrap up here, Dan.
I think it's going to be an interesting period of time coming up. I think I'm hopeful that we see some benefit to diversification going forward. I think there's just been it's not, the complacency. The more time passes, the more complacency grows. And what scares me the most is that the more we get conditioned to being saved and having this kind of really smooth ride and low volatility, the more the big bumps are gonna hurt. And we live in San Diego and the weather fluctuates 10 degrees, like you get freaked out when all of a sudden it rains one day or it's 50 degrees.
Right.
But when you live in Omaha, I mean,
Yeah. Right.
yeah,
Real.
negative 30, and you're fine.
Real.
Yeah,
Yeah.
you're used to volatility.
That's right.
I
Absolutely.
think yeah, we've been living in San Diego as an investor group in the U.S. for a long time. So
Yeah.
hopefully the fires don't come through, or yeah, I mean, but yeah, that's
Yeah.
it's my negativity shining through, but I like to stay
It's fair.
positive.
It's fair.
Innocent.
Awesome. Well, Dan, this has been a lot of fun. Really appreciate you spending time with us, sharing your insights. Where could people go to connect with you and learn more about your companies?
We've got a website for Evan Capital, and but please, my phone number's on it. We're on LinkedIn, email. Feel free to reach out. For Glenhaven Capital, it's that we can't advertise or have direct reach outs about, but glad to talk to anybody. I love talking about the markets and what we do, and always accessible.
Very cool. That's awesome. We'll make sure to include all that in the show notes, Dan. This has been a great conversation. A lot of fun.